Diversifying your investments is one of the smartest ways to manage risk and build a resilient portfolio. By spreading your money across different asset classes, industries, and geographic regions, you minimize the impact of any single investment's poor performance. Whether you're new to investing or looking to strengthen your strategy, understanding diversification can help you achieve more stable returns while protecting your wealth from market volatility. Today we will talk about how to diversify your investments and reduce risk. So before we start, make sure to hit the like button and subscribe to my channel. Understanding diversification. At its core, diversification is the financial equivalent of the old adage, "Don't put all your eggs in one basket." The idea is that different investments respond differently to market conditions. By combining assets with varying levels of risk, volatility, and return potential, you create a portfolio that can better withstand market fluctuations. Diversification doesn't eliminate risk entirely. It's not a guarantee against losses, but it significantly mitigates it by reducing your exposure to any one investment or market segment. Why diversification is important. Risk reduction. Market conditions rarely affect all assets in the same way. While one investment might lose value, another could gain, helping to offset losses. Diversification ensures no single event, like a sector downturn or geopolitical crisis, can devastate your entire portfolio. Smoother returns. By holding a mix of assets, your portfolio experiences less extreme ups and downs. The gains from some investments can cushion the losses from others, resulting in more stable overall performance. Exposure to growth opportunities. Diversification allows you to invest in multiple asset classes, sectors, and regions, exposing your portfolio to various growth opportunities. While one market might stagnate, another might flourish, keeping your portfolio balanced. Improved psychological comfort. Knowing that your investments are spread out reduces the stress of market volatility. This psychological benefit can help you stay the course and avoid impulsive decisions during downturns. Types of diversification. Asset class diversification. One of the most basic ways to diversify is by investing in different asset classes, such as stocks. Offer high growth potential but come with greater risk and volatility. Bonds. Provide stability and regular income, making them less risky than stocks. Real estate. Offers tangible assets and can act as a hedge against inflation. Commodities. Investments like gold or oil can provide protection against economic uncertainty. Cash or cash equivalents. Provide liquidity and safety but offer minimal returns. Geographic diversification. Investing in international markets spreads your risk across different economies and political landscapes. For example, if the U.S. market faces a downturn, investments in emerging markets or Europe might help offset losses. Sector diversification. Within the stock market, sectors often perform differently based on economic conditions. For instance, technology stocks may thrive during innovation booms. Healthcare stocks can perform well during recessions due to constant demand. Energy and utilities can provide stability as essential services. Holding stocks across sectors ensures you're not overly reliant on the success of any single industry. Investment style diversification. Balance growth-oriented investments, which prioritize capital appreciation, with value-oriented investments, which focus on undervalued assets with strong fundamentals. Adding dividend-paying stocks can further enhance portfolio stability. Time diversification. Investing consistently over time, a strategy known as dollar-cost averaging, can help smooth out the impact of market volatility. By purchasing assets at regular intervals, you avoid the risks associated with trying to time the market. How to diversify your portfolio. Assess your risk tolerance. Before building a diversified portfolio, understand your risk tolerance, your ability and willingness to endure losses. Younger investors with longer time horizons might prioritize growth-oriented assets like stocks, while retirees may lean toward bonds and other conservative investments. Start with broad-based funds, exchange-traded funds, ETFs, and index funds are excellent tools for diversification. They provide exposure to a wide array of stocks, bonds, or other assets, making them a cost-effective way to diversify quickly. Balance domestic and international exposure. Include investments from both domestic and international markets. Developed economies provide stability, while emerging markets offer higher growth potential. A mix ensures geographic diversification. Diversify within asset classes. Even within a single asset class like stocks, diversify further. Include small-cap, mid-cap, and large-cap stocks for varied risk and growth potential. Spread investments across sectors like technology, healthcare, and consumer goods. Don't forget alternative investments. Alternative investments, such as real estate, private equity, and hedge funds, can provide unique return potential and diversification benefits. However, they often require higher capital and carry additional risks. Regularly rebalance your portfolio. Over time, certain assets may outperform others, skewing your portfolio's allocation. Regularly rebalancing ensures you maintain your desired level of diversification and risk exposure. Challenges of diversification. Over-diversification. While spreading investments is essential, holding too many can dilute returns and make your portfolio difficult to manage. This is often referred to as diversification. Costs of diversification. Transaction fees and management costs can add up, especially when diversifying across multiple funds or assets. Low-cost options like index funds can help mitigate these expenses. Lack of expertise. Diversifying effectively requires knowledge about different asset classes and their behaviors. Without proper research, investors risk creating a portfolio that is poorly aligned with their goals. Market correlations. In some cases, assets that are typically uncorrelated, like stocks and bonds, may move in the same direction during extreme market events, reducing the effectiveness of diversification. Diversification for different investor types. Beginners. Start simple by investing in broad-based index funds or ETFs. These funds provide instant diversification across numerous stocks or bonds without requiring in-depth market knowledge. Intermediate investors. Experiment with sector-specific funds, international exposure, and a mix of individual stocks and bonds. Incorporate real estate investment trusts, REITs, or commodities for added diversification. Advanced investors. Explore alternative investments, such as venture capital or private equity, to add complexity and unique return potential to your portfolio. Use tools like options or futures for sophisticated hedging strategies. The role of technology in diversification. Robo-advisors and online platforms have revolutionized diversification, providing automated, low-cost portfolio management. These tools use algorithms to create and maintain diversified portfolios, tailored to an investor's risk tolerance and goals. The future of diversification. As markets evolve, diversification strategies will continue to adapt. Innovations like fractional investing allow individuals to access a wider array of assets at lower costs. Additionally, growing interest in socially responsible investing, SRI, and ESG-focused funds adds a new dimension to diversification, allowing investors to align their portfolios with personal values while spreading risk. If you like this video and would like to see more like it, please give it the thumbs up. Leave a comment and click the button to subscribe.